All right, stop what you're doing. If you're holding ServiceNow stock, you need to see this right now. Our AI radar has just detected a critical valuation gap.
And wow, it is flashing bright red. We're talking a massive 11.6% drop in a single day. And get this, the trading volume was 4.5 times higher than normal. That's not just retail panic, folks. That's an institutional exodus, and it's happening right now.
This is AI Stock Radar, and here we don't guess, we calculate. It's all about logic over emotion. And today, our target is ServiceNow. That's ticker NOW.
Just a quick heads up, our analysis is based on data from December 16, 2025, and this is for educational simulation purposes only.
Okay, let's get right into it. What's really going on here? Well, at the heart of this massive sell-off is a huge conflict. It's the hard data versus pure, unadulterated market fear.
So take a look at this. This is the whole story in one picture. On one side, you've got the fundamental reality, right? The logic. A stellar intrinsic score of 90, revenue growth soaring over 21%. I mean, that's solid. But then you look at the other side, the market sentiment, and it's pure emotion. Panic selling, a stock price that's just tanking, and that insane trading volume. You can literally see the gap widening between what the company is and what the market thinks it is.
So let's break down that fundamental reality side first. Let's look at the bull case. What does the data actually show? Why is our system rating this company so highly to begin with?
Okay, the foundation for the bull case is right here, a 21.5% jump in Q3 revenue. Let's be clear, this is not a company that's in decline. This is a company that is absolutely executing at a very, very high level.
And hey, it's not just about the revenue they just booked. Look at their backlog of future work. It's called Remaining Performance Obligation, or RPO. That's up a massive 24%. They've also got a 5-for-1 stock split coming up, which is a classic move to attract more everyday investors. On top of all that, their strategy to make money from AI is actually speeding up. So you add all this together, and that's why our model gives them that incredible intrinsic score of 90. The business itself, it's rock solid.
Okay, so if the fundamentals are that strong, then what's with all the panic, right? Let's flip over to the bear case. Let's see what has the market so incredibly spooked.
And here it is. This is the ghost haunting the stock right now. There are rumors swirling about a massive $7 billion acquisition of a company called Armis. And the market, it's having flashbacks. It's interpreting this exactly like it did with Adobe's failed attempt to buy Figma. It's seen as a huge red flag, a sign that maybe their own growth is slowing down, forcing them into a super risky, super expensive purchase right when the market is at its peak.
And this chart, this just perfectly illustrates the second major risk here, valuation. I mean, look at this. ServiceNow is trading at a forward PE ratio of around 50 times. Now, compare that to a competitor like Salesforce, which is sitting at 22. That's more than double. That's a massive premium. And it leaves a ton of room for the stock to fall hard if sentiment turns sour.
And it doesn't stop there. On top of that insane valuation premium, we're seeing insiders, including the CFO, selling off their shares. Our own model is flagging a huge macro headwind, giving it a score of -50. And this is all happening while this death of SaaS story is gaining steam. You know, the idea that the market is starting to question if these old school subscription software companies can really compete when AI promises to do the same work way more efficiently.
All right, so we've seen both sides, the rock-solid fundamentals and the powerful, overwhelming market fear. Our AI has crunched all the numbers, it's processed all that conflicting data. The target is locked. So, here comes the verdict. So our system has officially flagged ServiceNow with a critical risk rating. What does that actually mean? It means we're in a situation where all that negative market sentiment and the broader economic headwinds, they're literally overpowering the company's strong fundamental data. Simply put, in the short term, fear is winning the fight.
So here it is. The final verdict is bearish. Look, while the long-term fundamentals for the company are genuinely impressive, the numbers just don't lie. The critical short-term risk, driven by those acquisition fears and that sky-high valuation, it currently outweighs all of that fundamental strength.
The data is clear. The short-term risk is just too high right now. Remember our motto? Do not let emotion drive your trade. Subscribe to AI Stock Radar so you don't miss the next detection. Signing off.